Drink your coffee, read your sports, listen to the Dream Report. Let boy.
167 units. That is the total number of four-wheel drive large tractors sold in the entire United States this past April, down 42.6% year over year. Yet equipment finance executives have literally zero expectation of demand dropping. It is Monday morning, June 1, 2026. I am Marcus.
And I am Dana. We are looking at a market that just fractured right down the middle. If you are pricing iron today, the used equipment market is not one market anymore.
Exactly. This week, the data drew a bright line inside the comp pool. Earth-moving iron held or gained value, aerial lifts and telehandlers fell. And this happened in the exact same auction ring in the exact same quarter. Meanwhile, new equipment demand is at a record high, while actual new unit sales are collapsing.
Anyone pricing used iron right now needs to know which side of that line their asset sits on. This is a look at what the data says this week and why it matters for the job you are doing today.
Let us start with the split at auction. Ritchie Brothers published their May 2026 Market Trends Report on May 25. This covers Q1 2026 construction and transportation equipment.
The top-level takeaway is that overall construction and transportation prices were relatively stable Q1 versus Q4 of 2025. But when you look at the category level, the divergence is massive. You cannot just apply a blanket market condition adjustment across a mixed fleet right now.
Right. Earth-moving categories, meaning dozers, excavators, motor graders, and articulated dump trucks, they held or gained median auction prices in Q1 compared to Q4. They managed to do this even while sales volume was higher.
That is the critical detail for your work file. Higher volume usually puts downward pressure on the bid, but earth-moving absorbed that volume and held the line. The buyers are there, and they are willing to pay for late model hours. They need the machines on the dirt yesterday.
Then you look at the other side of the yard. Aerial lifts, telehandlers, and forklifts all saw declines in median auction prices in Q1 2026. The report points to higher supply volume contributing to that drop. Boom lifts and scissor lifts just couldn't absorb the overhang. The rental fleets cycle out older units, and the secondary market is clearly feeling the weight of it. So when you're pulling comps from Ritchie Bros auctions in Q1 2026, you have to treat those categories very differently.
The earth-moving comps are solid. They held up under volume pressure. The aerial lift and telehandler comps might look a little light, but that supply overhang is real, and it's in the data. You have to account for it when you're looking at the meter readings and condition reports.
You need to cite which quarter your comps came from and explicitly flag that category-level direction in your report. Don't just average out the whole construction sector and call it stable. The asset class dictates the trend. If a client asks why your scissor lift values are soft while the excavators are holding, you point them directly to this Ritchie Bros May 2026 report.
That auction stability in earth-moving makes a lot more sense when you look at what's happening on the new side. We have a massive paradox right now. Demand is at a record high, but new unit sales are collapsing.
The Association of Equipment Manufacturers released their April 2026 data this May. Total U.S. farm tractor unit sales are down 11.3% year over year. Tractors over 100 horsepower are down 8.0%, and like I mentioned at the top, four-wheel drive large tractors just fell off a cliff. They are down 42.6% year over year, only 167 units sold nationwide in April. Kurt Blades, the AEM senior vice president, attributed the declines to lingering softness in the equipment market. That's a direct quote from AEM.org. But the financing data tells a completely different story about demand. The money is absolutely there.
It really is. The Equipment Leasing and Finance Association, ELFA, published their Q1 2026 CapEx Finance Index in May. It showed new equipment demand reaching record-breaking levels in the first quarter. People want to buy iron.
And their monthly confidence index for May 2026 hit 69.9. That is up 5.3 points from April. The share of equipment finance executives expecting CapEx demand to increase over the next 4 months jumped from 10.5% to 26.1%.
That is roughly a 15.6-point jump in just 1 month. And the number of executives expecting demand to decline is 0. Not a rounding error, 0. Every single executive surveyed either thinks demand will hold steady or increase.
So you have record financing demand and record new equipment interest, but it is not translating into record new unit deliveries. Buyers are facing tariff-driven lead times, severely constrained supply, and general hesitation on massive capital purchases. They get approved for the financing, but they cannot get the machine they want on the timeline they need.
Which keeps those buyers in the used market. That demand pressure on used inventory is a big reason why used values held at Ritchie Bros, especially in the earth-moving categories. People need to put iron on the dirt, and if they cannot get new, they bid up the late model used.
For appraisers, this means the spread between replacement cost new and fair market value on late model iron is widening. It is not because the asset depreciated faster. It is because new is significantly more expensive and much harder to get.
That changes your cost approach inputs fundamentally. You have to verify OEM pricing as of your effective date. You cannot rely on last year's price book right now. The RCN has moved, and if you miss it, your depreciation calculations will be completely out of sync with the market.
When you define your scope of work, make sure you state exactly how you are sourcing that RCN. If the OEM cannot give you a firm delivery date or a locked price, you need to document that reality. The widening spread is a market condition, not a math error.
We are seeing this exact same dynamic play out in the agricultural sector. Casey Seymour and Greg Peterson talked about this on the Moving Iron podcast last week on their May 21 episode titled Understanding the New Normal in Ag Equipment.
They framed the current ag equipment market as the new normal. You have strong used values sitting right alongside sluggish new sales, and they made the point that this disconnect is not a temporary correction in progress. It is a structural condition.
Right. They pointed to input costs, financing rates, and extreme farmer caution on new capital as the drivers. It's a structural wall. Farmers are looking at the price of a new combine, looking at their input costs, and deciding to run their current fleet another season or buy late model used.
They also had Sean Hackett from Hackett Financial on that same episode to discuss the macro commodity backdrop. He brought up drought risk for major crop regions, oil volatility, and the U.S.-China trade dynamic. All that macro noise keeps farmers from pulling the trigger on new iron, even when Alpha says the financing is totally accessible.
Speaking of oil volatility, WTI crude fell into the high 80s per barrel this week. That's down roughly 13% on reports of ceasefire extension talks. Operating costs for high idle and fuel-intensive equipment do ease up when diesel follows crude down, but it's just one more moving piece in the background.
It is. But back to the ag iron on the ground. If you're pricing used ag equipment right now, your comp pool is thin, and the market is structurally disconnected from the new sales channel. Casey and Greg are right. This is not going to self-correct in 60 days.
You have to factor that inventory scarcity into your analysis. Thin comps are not the same as bad comps. They just require more work. You need to disclose the lack of volume and reconcile it clearly in your work file.
Exactly. If a farmer cannot get a new combine, they will pay a premium for a 1,500-hour machine, and your report needs to explain why that premium exists. You cannot just look at a scatter plot of 3 sales from the last 6 months and call it a day. You have to explain the market conditions driving those sales. When new inventory is choked off, the used market has to absorb the demand. That is what we are seeing across the board, from earth-moving to ag.
The practical question for the appraiser this week is simple. Which half of the market am I working in today?
Yeah.
If it is earth-moving, meaning excavators, dozers, motor graders, the auction comps from Q1 held. Volume was higher and the data is relatively clean.
Right.
If it is aerial lifts, telehandlers, or forklifts, the Q1 comps may understate value because a supply overhang pushed prices down. Pull your comps, note the category trend, and disclose it.
Absolutely.
If it is used ag iron, the comp pool is thin. New sales data is collapsing, and the bid has held simply because buyers cannot get new. That is a fundamentally different valuation environment than a year ago. No prediction on where this goes. That is not the job. The job is knowing where the market is today and documenting it. That is what we have this week.